Happy Friday to everybody. Thank you for joining us for another Condo Insider. In case you are not aware, ThinkTech Hawaii used to be our producer for Condo Insider, but end of April they had retired. So since Hawaii Council wanted to continue on with our Condo Insider, we found Ikaika and Key Media. So he is now doing our Condo Insiders, recording it and setting it all up. So we're really thankful to have met Ikaika. So today we are going to talk about CPACE financing. It's kind of a follow-up to our seminar that we had last week. So I want to introduce Gwen Yamamoto Lau, who is the Executive Director of the Hawaii Green Infrastructure Authority, which is part of the Department of Business, Economic Development and Tourism, also known as DBED. So I'm going to turn it over to Gwen to talk about CPACE and to also introduce our two CPACE lenders that are on the call with us today.
Great. Thank you so much, Raylene. So just a little bit more, the Hawaii Green Infrastructure Authority is, as Raylene mentioned, an agency attached to DBED. And under Act 41, which the governor signed into law on May 30th of this year, the authority administers the CPACER financing program for the state. CPACER, which stands for Commercial Property Assessed Clean Energy and Resiliency, is a new financing option for commercial property owners. Our goal is not to replace financing from our local banks or credit unions. Our goal is to provide commercial property owners, including condominium associations, another financing option to consider. There are two characteristics of CPACER financing that is different from traditional financing. Instead of a mortgage over the property, the financing is secured by a governmental lien that is subordinate to a real property tax, but senior to a mortgage, which is the reason lender consent is required for properties with existing commercial mortgages or condominium associations with existing loans. However, it is this governmental lien which mitigates risks that allows CPACE lenders to stretch the loan term over the useful life of the retrofit being financed. While there are specific qualifying improvements that can be financed for commercial properties, for condominium associations, CPACER financing can be used for any retrofit or upgrade that is needed that is affixed to the property or the building, including repiping, fire sprinklers, elevator upgrades, spalling, and water or energy conservation measures. In fact, we have been working with the Board of Water Supply and Hawaii Energy and encourage water conservation and energy efficiency measures to be bundled with the necessary improvements to help lower the association's water and electric bills. And joining us today, and Raylene will be talking story with Michael Yaki, who is Senior Vice President of Petro PACE Financing, and Ron Adachi, Managing Director of PACE Equity. Raylene?
Okay, thank you, Gwen. So right now in Hawaii, we have, now with the addition of CPACE, condos really have three avenues to finance the repairs or replacement, depending on what it is. So we want to make that really clear. It depends on what the item is. Also, it depends on the certain requirements of the loan or CPACE. Like typically if it's going to be an energy efficient upgrade for the condo should really look at CPACE financing. Also look at any opportunities that you might get rebates back from Hawaii Energy that you can tie in together. I know like Bank of Hawaii can do lease. So I know some condos have used the lease for their fire alarm systems. And then they also do loans for some of the other things, and they also got to take a look at what the overall payments are going to be over the life of how it's going to be amortized and what that period is. So they have all these different math figurations that they need to consider. And bottom line is how it's going to impact. And that's the big thing that everybody's going to be looking at, is how is it going to impact their monthly maintenance fees. So let me start off with Ron. So can you kind of let us know a little bit more about the type of qualifying improvements, and do they vary? Because we have two different CPACE lenders here. So kind of give an idea of that. One lender might do it, but then another lender might not do it.
No, that's
Thanks.
it's a very good question, Raylene. And well, pretty much all the senior lender or CPACE providers will actually go by and follow the actual lending requirements that are defined by the CPACE program that Gwen and HGI had set up. And based on that, that's kind of the first piece that we would look at. And then every individual CPACE provider has different asset classes that they will do. Hawaii tends to be a lot more inclusive. They included wind resiliency, cesspool remediation, and a lot more inclusive outside of what traditional programs have done in the mainland. And there's probably just certain ones that may or may not be able to be qualified. There's, like wind turbines, for instance, they may be something that it would be called an esoteric type application. Those would be ones that we would just have to do those as exceptions. But overall, I'd say the majority of what they have already spelled out, the CPACE program, is aligned with what most CPACE providers would actually be able to underwrite and qualify.
So some of our typical ones that most of the condos are dealing with right now, I know they're dealing with a lot of window replacements, piping, repiping, and even the vent stack thingies, elevator modernizations, and some of them are even in tuned with that. They're looking at installation of solar panels.
Yes. Yeah. So
because
those all
with that, with the installation of solar panels, it'll bring their energy costs down, which will ultimately help with their electric bills, the individual unit electric bills. That if they lower that bill, but then they won't be so hard up on the not hard up, but bark too much about the increase of maintenance fees, but because they're saving on one, right?
Sure.
To get some required improvements done and repairs done. So
yeah, all the ones that you've outlined just now are the essence of the legislation, which was to promote energy and water sustainability. And those are very, very much basics right up the middle for us to be able to fund on that side. And obviously building to code, as Hawaii has one of the more stringent building codes that you have put in place. They would pretty much fulfill that as well.
So one that I see on the list on the Hawaii CPACER list is EV charging stations, which just came up in conversation yesterday with another board member yesterday that was calling me about EV charging stations. Is that something that you as a lender that you guys would do?
Yeah, I've done many already. Mainly, people have done it in multifamily developments and condos as well. Because again, it's promotion of electric vehicles, which is going to be we look at it from a low carbon footprint perspective. That's us personally. But I think the other I can't speak for the other CPACE providers, but we've definitely included that in fundings that we've had in the past.
There's another one on this list that I see: storm and sea level rise. All our coastal condos are kind of eroding away. Well, even Hawaii Kai, the peninsula, I know their wall, they had to be regrouted. There was something with the wall, and that was a big issue, because that's been around. That wall's been around for 40 years, 50 years. When Kaiser started dredging into that area, right? So it's due for retrofits or going back and redoing it all. So is that kind of like within that category of CPACE?
That one, at least from I can't speak for the other providers. That would be something that we would need to kind of better understand. It hasn't really come across as something that we've ever reviewed before. So it would be one that we would have to just take an exception to. And if it would just be something that we would disclose from the underwriting piece. But in most cases, like I said, if it's water or energy efficient, then that's kind of our test that we have. And then we'd probably go back to the Gwen's group and kind of decide between us, does it make sense for us to pursue an underwrite? Because ultimately we have to first comply with HGIA and how they set up the program. That's first and foremost.
So that would be one of it depends, because I remember hearing that at the seminar. It depends.
And that's this full disclosure. And I shared with my partners, Hawaii, new construction, we're very straightforward on. As it pertains to condominiums, it is to be determined in terms of how we actually have that path going forward, because there is the way that we really need to tie it to the collateralization of the land separating it from the individual landowners. I mean, the individual property owners that we have.
Okay. And this, I know this came up, and it's kind of a standard underwriting thing with regular mortgages, residential mortgages, is insurance. Everybody's gonna face the same issue, whether you're doing a lease or doing a bank loan, is the replacement value of the building on their insurance. Because some condos have reduced that down to less than 100%. So the question is, are you guys gonna look at that and require 100% replacement? Is there a look back period that you're also gonna consider on that too?
In traditional loans we've done in the past, not on individual condominium units, because we have not done a retroactive or a retrofit of individuals, but for new builds, we are requiring that in traditional buildings on that side. So we haven't determined if it's going to be 100% or if there's going to be a look back period. So that would be one we would really need to understand when we get to a closing, to see where that fits in the underwriting, but also in the closing process.
So the replacement, so that could be determined a little bit more upfront, right, versus.
Oh, absolutely, yeah, and that would be again something that we would work with Gwen and her team to determine where that would be at. But typically, I can just share our experiences on projects that we have funded that are retrofits, and it has been required an insurance certificate replacing, at replacement value.
I also kind of wanted to get your input, or actually Gwen, both of you guys, that we talk about the mortgages on the property. We want to make it clear, because I have it in a question here, is that it's not going to impact the individual. The financing is not going to impact the individual unit. It is the condo property, the association property. So if a condo unit was going to refinance, the CPACE loan, if it was recorded, will have no impact on that individual unit refinance, correct?
Absolutely. Absolutely. The CPACE assessment is not recorded on the unit owner's tax map key. So therefore, if escrow pulls a title report, it doesn't show up because it isn't attached to that. And then I also wanted to circle back on the insurance. I think during last week's luncheon meeting that you had, Michael was also on that meeting, and he did mention that they may be willing to finance without 100% replacement value while the condominium association is doing their retrofits and upgrades and different maintenance issues, because they understand that sometimes it's hard to get insurance because of that. But once the retrofits and the upgrades are in place, they do expect to get 100% insurance on that. So, that might give condominium associations a little bit of relief while they are fixing their whatever they need fixing.
Yeah, they still have to recognize that they can't run away from the 100% replacement forever. It's going to it eventually will catch up to them.
And one thing that I would say on that, I think Gwen brings up a good point, but even though the individual unit would not have it, for the actual HOA or the AOAO would need to actually disclose that there is an assessment that they are responsible for. So if anyone were to be refinancing, whoever's refinancing, or if anyone would be buying the new unit, they would know that there is a CPACER assessment that is on the unit, of which they just have a fractional interest in, is kind of what, when we had our partners and our underwriters looking at it, because again, it's uncharted ground, but because we would still need to tie it back to an APN, which would be the AOAO's APN. So I don't want to confuse the conference, but that's what they're anticipating, is that there still needs to be some type of a line of sight back from collateralization if something does happen.
No, that's a good point, because that would be part of the seller's disclosure.
Exactly.
Should appear on the RR 105C that the managing agent also does.
Correct.
That should
It would
appear.
just have to be revised once the assessment is in place. It would have to be a revision and addendum to the CCNRs.
Yeah, that's a good point.
But I don't think it's much different from current practices with a regular bank loan. Yep. The condo association would probably disclose the liability of the bank loan right now.
Yep.
Right.
Good point.
Ron, can you explain to us the application process? So are they filling out like a 1003, or you guys have your own application form?
Well, we've been very fortunate working very collaboratively with Gwen and her team at HGIA. But if anything comes to her process, they actually have kind of a checklist of things that they can help get us started. We typically, and I'm working with some groups that I'm coming in working with directly, but there's just basic information that we would need. And obviously would be the sponsoring entity that they would need to have, HOAO, AOAO contact, the actual scope of work that they would be done. And ideally, if there's an itemized, we call it a construction budget with a schedule value by trade, broken down by, dollar amounts that they would have. And then based on that, we would need to have, the financials, typically 3 years financials. And in this case, in an AOAOs, we just need to have their running financials that they have. And if they have a reserve account, what's in place on that end. And then if they have any type of an appraisal, and that's the area that we're having the biggest challenge getting our arms around, is how are we doing the valuation of the AOAO to be able to help us understand what's the actual valuation of the actual property that actually is going to be the signatory for the actual lien assessment that they have. But those are the basic pieces that we need to have. Once we have those, what we do from a process perspective is we then get are called high-level indicative terms. They're called non-binding soft indicative terms. And then based on that, we get in productive discussions with said sponsor, our AOAO in this particular case. And then we would go to what we call a financing commitment or a project development agreement. And then after that, we're able to then submit the actual application to Gwen and her team at HGIA. And it gets formally set up in the queue as a bona fide project qualified moving forward.
So either the property manager, the CAM, can complete the application process, or it could be done by a board member. But what about the signature on the application?
That would, I would assume, be the signatory on the AOAO. Again, because it's uncharted ground. Maybe Michael, from your legal perspective, who would I'm going to defer all the legal and the more difficult questions to Michael. So thank you for coming back, Michael. He went to law school. I went for the MBA.
This is what I get for jumping off for a few minutes. It's just punishment, I would say. Well, I mean, there's always in any corporate entity, there is someone who is through the corporate charter empowered to sign on behalf of the association, so long as there is whatever duly noted vote that's recorded that gives them that power. So in this case, in all probability, it'll be the president of the AOAO who would be signing, or some other officer of the AOAO, depending on their bylaws. So I mean, I would see that as an issue. I think that the bigger issue is really what Ron and others and I have been talking about before, which is it is uncharted territory. CPACE works in a situation where it grabs onto something. It's sticky to land, and then with a condo association, we're sticking to an association that sticks to the land. So it's kind of like one thing removed. How we work with that. I mean, and this is the first statute that gives us the authority to really work with an AOAO. It's always been something that we've sort of tried to work around or try to figure out how to do. This one creates essentially a taxable, I wouldn't say taxable, but an entity that we can attach the CPACE lien to. And then the part that we're all going to be working on, Ron's company, my company, and others, is how we take that attachment, how we take that stickiness of the CPACE lien to the AOAO to make sure it kind of sticks a little bit sticks as much as it can to the value of the condominium project itself, for the purpose that not only can we get repaid, but we have the kind of security that allows us to stand the kind of interest rate terms that CPACE is known for.
Okay, so one thing I want to make it clear to everyone, because I've heard this word a couple times, is uncharted territory. So it's these, both Mike and Ron, it's not uncharted territory as far as CPACE is concerned. It's uncharted territory as far as coming into the Hawaii market, because this was something new that just got signed into law, but it's been around for many years. I think Hawaii is one of 38 other states. These other states already have it, CPACE already in place, and it's working. So I want to make it sure to everybody that uncharted means that we're not the first ones.
It's really not uncharted like Gilligan's Island uncharted. We're not going on a 3-hour tour and never coming back. I think myself, how many other people actually remember that reference? I'm dating myself, or I've received too many reruns on Nickelodeon. So, I mean, you're right. 35 other states. We're active in about 31. Hawaii is going to be like the 32nd program. There are others going to be coming online: Georgia, North Carolina, Idaho, and others. I'll make it up to 35. But Gwen has done terrific work in getting the program to the state, getting to the stage, and I predict that there will be applications rolling in this month. If they're not already on her desk, on sort of traditional CPACE projects. And what Ron and I both do is we also do new construction condominium projects. That's a little bit easier to handle from a legal perspective. Retrofits, though, we're excited about. There's a lot. We think that it's a good market. We think I think we can all sort of work together and figure out a way to make this work and share in what I think is really a tremendous opportunity, and one where basically we're helping public policy and helping homeowners out with the fact that they have these mandates that they have to adhere to, and they have insurance requirements that they need in order to the requirements in order to get insurance. And someone once asked me the question, well, don't they need the insurance before they get the CPACE? The answer is probably not, because they wouldn't be asking for the CPACE to get them to that stage. We do this a lot in other states as well, whether it's in hotels or multifamily in Florida, where we help property owners get their insurance ratings down, or get their hurricane mitigation up to get their insurance ratings down, so they can qualify and afford the kind of insurance, hurricane insurance that's like fire insurance in California is like kind of going through the roof. I'm sure it's the same thing in Hawaii as well. So this is something where we think that we can be it can be very beneficial. We can really be very, very helpful. It's one that I know that Ron's company, Pace Equity Mind, Petrospace Finance, are really looking forward to cracking that nut. Whether it's a kukui nut, macadamia, I don't know, but we'll figure out a way to make it work.
Okay, so Michael, since you came back, so how is the loan funded, and who distributes is it like a regular, is it kind of like a construction loan where they're basically the contractor or the AO is not giving the money up front, right? It's split up.
No. First of all, all of our companies, all the CPACE capital providers that are not banks, we all have essentially access to warehouse lines of credit that enable us to advance money to property owners. But what we do, and what's required under the statute, is that this is going for certain things. So it usually goes into a trustee account, and disbursements are made as improvements are done. So we're not just throwing a bunch of money at the property owner saying, hey, go to town. That's not how it works. That's not how we work. That's not how Ron's company works. We make sure that there are draws on the money that are verified through receipts or orders or some other process between the property owner, the contractor, and the depository institution where the funds are held, in order to make sure that we only are funding those things that we said we were going to fund on behalf of the property owner.
And the point of contact for the release of draws, like some of these projects would more than likely have a project manager. So that would be an identified person to be able to confirm, like in residential construction, usually that's the appraisal that goes back to confirm, and it says, okay, time to release the next draw, things of that nature. So same other concept right?
Yeah, and this would all be worked out in the legal documents between us and the property owner and whoever they choose, it's their GC or their project manager, and the trustee that's going to be holding the funds. And there's different ways that we can structure this, structure that the funds. We can do it in tranches, we can do it in different draws, to sort of reduce the impact or interest rate that the accumulated interest for property owners. So there's a lot of creativity that we can utilize to make this work. But I think that the fact is we're as much as we are different, we are also very much alike the way any construction financing works today. So people shouldn't be that intimidated by, well, it's different, or they have all these other crazy rules. And no, it's not. We in fact, the more we have advanced, I think, to a point where we are very interchangeable as any other form of finance, construction finance you may have, in putting together what you need, what your capital stack may be, or your funding goal would be, for the project that you're trying to do.
So is there a limit amount of draws that you would do? Or depend on the size?
No, it would depend on the size and the nature of the project. I mean, if it's, new construction, it just goes in big chunks. If it's retrofit and it's piping and HVAC, those kinds of things, they would go in discrete chunks along the way. Again, these are things that we can work out, and it's like I said, it's really nothing different than the way people are doing nowadays. We don't want to create any additional friction between how property owners are used to working in terms of improving their property. So I don't think anyone has to worry about that.
Okay, so that should dispel the rumor that I heard that a contractor was saying that they have to put the money up front and then I don't think it works that way. It's like a construction loan.
No, yeah, and no, what's interesting, there was one program in this country that actually did that, and no one went there. Everyone just said, sorry, that's really not CPACE as we know it, and the industry just said, that's just nuts. And we have to behave like other forms of financing in order to succeed. We can't behave, in a weird, to coin a phrase that's very popular nowadays, a very weird manner. We're not weird financing. We're very straightforward, conventional in terms of how you deal with it. We're just a little different in the way that we act on the property, in terms of repayment over time.
Is there one condo example or typical, well, probably better if they can visualize it with a condo where you did a retrofit and how that worked out for that condo, like as far as payments? Is it amortized over the life of the item? And then when do they start making their first payment?
So the magic of CPACE is that 99% of it is fixed rate, fully amortized financing, and you can include in there capitalized interest period during construction, so that you're not having to pay while you're actually trying to build the darn thing. It's usually after the completion of construction. We can build in interest only periods as well to sort of get you sort of ratcheting up to where the payments are. And because of the types of improvements that Gwen and the HIA have approved, we really have the ability to extend the life out, because a lot of these things have very long useful lives, especially because of the kinds of things that Gwen have approved. That enables us to put it out. And if everyone knows, if you can fund low and fund long, the annual payments are going to be a lot different, a lot lower than you normally might experience in a traditional kind of bank financing. No balloon payment at the end, no interest rate fluctuation, no ARM, that kind of stuff. And it gives you the ability, quite frankly, that if interest rates go really far down, you can refinance us out. I mean, you can just say, well, I can get cheaper money now, but in the meantime, you can build upon, for your planning, what those payments are going to be, because they're going to be the same each year once the amortization starts. So I'm going to be very honest. We have not done a retrofit of a condo, mainly because concerns regarding in other states regarding residential pace and other things. But the closest analog would be like a co-op. There are a lot of co-ops that a lot of us have done. Where you're working with a co-op board, that the lien goes against the cooperation corporate entity. The property owners are assessed. The shareholders are assessed according to their percentage share, and in a condo unit, it would be your square footage basically, or your view and things like that. And that works out very well. We've been very successful in that, and that's the kind of model that we're looking at to see how we can tweak that to work for condo retrofits in Hawaii.
Okay, I want to address this one. We do these seminar evaluations, after seminar evaluations. So there was one that he commented about CPACER. The question was, is the CPACE financing to be considered for a future qualifying repair? And it said yes, but not to drag out payoffs. And it's kind of eluding me to thinking that the amortization period, they're thinking because it can be long. So I think that maybe that's what he's referring to as drag out the payoff. But again, the longer the amortization, it might reduce down versus if you had a shorter term, right?
Well, it's like a homeowner. Do I want a 10-year mortgage? Do I want a 15, 20, 25? Can I afford a 30? And I think one of the things that all the AOAOs are going to have to do is sit with their membership and try and figure out what is the number that we can all handle, and to kind of work backwards from there, right? In other words, because that number is going to determine the term and the amount that you can finance. You just can't say, well, I'm going to do $10 million and then figure out, oh God, it's going to be like, $800 a month per unit to pay it off. Everyone go, so you've got to, AOAOs and their membership have got to think and work on this very carefully, because it's not just what we can offer, it's what they can also afford in their monthly fees in order to repay the yearly assessment. Because we're, like I said, we have to figure out how we're going to get comfortable with the issue of the stickiness of the CPACE to the property, but they've got to figure out how much they can afford each month in order to make the annual payment. And in all probability, and I'm probably not speaking out of turn, Ron, probably some kind of reserve amount for the delinquencies that you're going to be seeing from some of the individual condo owners who, are absentee or don't care about paying HOAs. I mean, I'm sure that you Raylene, you've experienced this a lot. There's some folks who just don't
not
pay.
Paying for that because typical, like, I don't go to the pool, so why should I have to pay for that
Right.
portion? We're like, you bought it with the pool.
You bought it with a pool. That pool gives your condo value. And if you took away the pool, do you think you would rent your short-term rental? I don't think so.
Yeah. Okay. There was one last question. I forgot what it was. But I really appreciate all of you, Michael, Gwen, and Ron, being here again for kind of like a recap of our seminar. I think it was really good. And I really think if we might have another, I might have another question I'll pose to Gwen, and she can reach out to you guys for the answer. But that I have what I have thinking in my head, spinning, is something that it might solve or help to dissuade some vibes regarding CPACE. But ultimately, we really have three avenues to finance all these repairs that some of these buildings are in desperate need of doing. Because ultimately, if you don't do the repair, we're looking at another Surfside, potentially.
Right,
that could
right.
happen, right? Especially with pipes, and concrete walls. That's not going to, concrete absorbs water, right? So everybody's got to face up to it. I know for us, we're really trying to, White Council, we're trying to also trying to educate them on other little small things that they could use to save money. Sometimes those small things add up to big, savings over time. So hopefully that, but this is something that we cannot hide from. No,
And Raylene, one thing I would say, you talk about the three options. It doesn't mean that they all have to exist separately. I mean, one of the things that you see in any big ticket item is that there's a combination. You may
Right.
want to take out a bank loan at low interest for a short, for a certain amount of money for a short period of time. But you may want to back up like part of it also with the pace for the longer term stability toward the end. So these are all things that we see in new construction, especially, that you have a capital stack that's made up of all these items together, because together they can work better than they try and do it separately. I think that a lot of the work in condos in Hawaii for retrofit, it's going to probably become close to that.
Oh no, yeah, I definitely agree.
So,
like some might be taking a lease option, the lease ones through Bank of Hawaii first, and that only qualifies for certain items.
right.
And they might do a bank loan for the other one, but they might do the CPACE for the other one, but tie it in with Hawaii Energy. And also CPACE, you guys mentioned you guys take the tax credits. So how does that work? Like for solar,
For solar, it's whoever the owner of the system is.
Yeah, whoever owns it actually has rights to those tax credits, and it doesn't really affect how we would underwrite it. We would just look at it as a source of capital and what we're funding.
And not to further complicate it, but under the IRA, there is direct pay where nonprofits can get that 30% back from the federal government.
Yep.
Okay, so I think after this, after people review it, they should feel a little bit more relaxed on the opportunity that CPACE could have. One last question I have, and I remembered what it was. Would you have only one CPACE loan at the time? That was posed to me, and I go, well, and then they said, well, what if they refinanced the existing CPACE and did more improvements? I go, oh, that would be a mathematical headache to do the assessment.
Oh, no, we do that all the time. I mean, first of all, remember because of the way the program is structured, we're working with Gwen to make that work. The assessment doesn't have to get calculated into accounting or anything like that. So we can do basically a new amortization table and then send and let Gwen know what the payment is going to be for the next year on a pretty very easy basis. So that's not going to be the issue. But we do see a lot that sometimes you'll see CPACE do like 5 items out of 10 because they just couldn't figure out how to get money for the other 10 or the other 5 or what have you. Then interest rates drop or they recapitalize in some other aspect, and then you can then they'll say, well, okay, so let's do the other 5, but then also that CPACE was at 8. If we can redo it at 5 and get the extra money, we can do that as well. That happens, quite frankly, in the CPACE world a lot. It's just like any other type of refinancing that you would do with a bank loan or your mortgage or what have you. Always tell people go to where the money is cheapest, and if you can leverage it to do other work, like a home equity loan or something like that, do that. So same with CPACE.
Cool. Any other comments that Mike or Ron you want to add in for our audience regarding CPACE?
Your turn, Ron. Come on.
So I would just say that, because, it's still a relatively new program, we're actively looking at, projects now. The best way that we're actually going to learn through this process is actually taking a live project and going down the road with them. So, again, just understand that we're working in partnership with Gwen and her team. And again, a lot of things will be learned through discovery through this process.
Okay. Right. Gwen, did you have any closing comments?
No, just thanks for the opportunity. I did want to say people probably saw my lights go off. It's a state holiday, and so it's only on for 1 hour. I got to go run and turn it back on, but the state does pay its electric bills. It's just a holiday.
Well, that's good to know that they power down on the holidays.
I thought maybe you had one of those lights that if you don't move for a while, they just shut off. You have to jump up in the air.
But really, thank you so much for the opportunity to share more about CPACER to your.
Thank you. I really appreciate your time. Again, Gwen, thank you. I really appreciate, even though today is a state holiday, we still did this. I really appreciate that. And to Ron and Michael, have a great weekend. And again, really thank you very much for being involved in our Hawaii CPACE program.
Great.
Mahalo.
Happy aloha.
Thank you.